but we have a market conversation that we need to go forward with. Varun Lohchab from HDFC Securities is joining us now to discuss market fundamentals. Varun, good morning. Thank you so much for joining in. Most of quarter three, 2 months of quarter three are over as well. What's the sense that you've been getting now in terms of your conversations with corporates? Because quarter two did see a lot of earnings downgrade. Are things improving now in quarter three? And which sectors are seeing better improvement?
Yeah, good morning. So quarter two and actually even quarter one was fairly weak, and we saw downgrades in both the quarters. It's just that market was in a bullish phase in Q1, so it ignored the weak earnings. So first half we have seen around 4 to 5% downgrades. We were anyway way below consensus at the start of the year. We were forecasting only 6 to 7% growth for this entire financial year, which has now actually got further downgraded to around 3%. Q3 we believe will be better than Q2 because of 2 or 3 reasons. One, I think the expectations were running too high, partly also because of analysts penciling in very sort of generous numbers because of stock prices moving up. So what tends to happen in a very strong bull market, analysts tend to overestimate earnings because they need to catch up their target prices with the stock prices, and therefore the moment we see bit of slowdown, the downgrades seem to be sharper than what the actual slowdown is. And secondly, the base will get better in Q3. If you look at Q2 also, ex OMCs, the growth was around 9%, and the base for OMCs will get better from Q3. So for second half, we are expecting around 7 to 8% YOY earning growth for our coverage universe, which is better than what we saw in the first half of the financial year. And also, festive season has been reasonably okay. If you look at, some of the select pockets like consumer durable, most of the companies have talked about a good festive season demand. Among the automobiles, especially two-wheelers, have had a reasonably decent festive period. Jewelry demand was also reasonably good. So we don't think there is a all-round big pressure on consumption also the way it is looking at the Q2 numbers. The problem is in select pockets. Problem is at mass consumption items in urban. So urban middle class and urban poor is where the impact has been high of the food inflation, and that will take few months to sort out. But barring that, both rural as well as the top half of the urban population, they seem to be quite okay in terms of consumption. So second half to be slightly better. Valuations have corrected, so I think that now again starts to provide some upside at an aggregate market level over a 6 to 12 month period, but it would still be a fairly muted sort of a return and very stock specific market, and not a broad based all out rally the way we saw in the previous 12 to 15 months.
Hi Varun, just a few quick questions on what you said. One, H2 earnings growth is 7 to 8%. What was the comparable number for H1?
So H1 was actually close to 0 to -1 for our coverage universe. 0.
Okay, so and you also said
full year number of around 3.5–4%.
3.5 to 4%, got it. And you also said that the urban poor and the urban middle class is where we've seen stress, particularly consumption stress. So if in terms, in terms of actionable ideas, how would you play this? Because rural is doing well, so rural consumption. So how would you differentiate, and which would be the impacted stocks?
So see, there are again a few more nuances to it. If you look at FMCG, there is also an issue of quick commerce impacting them because of fragmentation, and there is a share of wallet issue with FMCG, that more and more spends are going toward discretionary items. So right now in consumption, we are preferring consumer discretionary over staples at an aggregate level. So we are positive on consumer durables. We are positive on select apparel names as well. We are positive on liquor stocks. We are positive on select FMCG, but overall as FMCG as a basket, we are underweight because we believe the issues of growth will continue to especially quick commerce in urban will continue to impact their growth. But you have to be very, very stock selective. Something which is very exposed to rural might continue to do better in second half. So we have names like Imami, Dabur, where we have a positive rating, even Marico for that matter, within staples. So it's very stock specific rather than getting overly bearish on consumption at this point of time. We have two-wheeler stocks in our model portfolio. We continue to hold them.
Oh. I remember in the last conversation, I think you had said that you were underweight on mid-cap and small-cap IT. This was about a couple of months back. Has that view changed? Because IT has gotten re-rated in the last few months.
Not really. We are not increasing our weight in IT sector. We have we had cut from underweight to neutral almost 3-4 quarters back, but it was largely in the in the larger companies rather than getting into the small and mid caps in IT, because their valuations seem slightly more stretched compared to even the growth improvement that we are seeing. And we don't expect that IT will go to double-digit growth anytime soon. At an aggregate sector level, there will always be few stocks which will be doing that. But we believe as the domestic demand comes back in second half and FY26, IT will probably start to look less attractive on a relative basis, going forward. So we are not increasing our weight in IT sector.
Okay, all right, Varun, thank you so much for joining us with your thoughts and idea on overall markets and specific sectors as well. That's the word coming in from HDFC Securities on overall markets. But time for a short break. When we come back, we'll discuss what's been the story of the day and been the story for last couple of weeks as well. Sachin Gupta from KRH Ratings along with AM Karthik from ICRA will join in to discuss the tighter lending norms for microloans and what's happening in the microfinance institutions. Stay tuned.